Welcome back to Market on Close. We're just a few minutes away from the closing bell for this trading day. It's time for the big picture. Let's welcome in the team from Charles Schwab. We've got Collin Martin, Director Fixed Income Strategist for the Schwab Centre of Financial Research, and Ann Sonders, Chief Investment Strategist at Charles Schwab. Thank you so much for your time, both of you. Ann, let's start with you. Just your thoughts on today's session off the back of seemingly a bit of a pullback following the post-Powell rally.
Yeah, so it's carrying a little of the momentum that we saw in the aftermath of Powell's speech, which was seen, at least based on probabilities around the September meeting, as being dovish. I'm not so sure the speech more broadly should be seen as dovish, given the change to the framework and the dropping of the average part of the flexible average inflation targeting. I think that was a bit more hawkish, but you kick some momentum back in some of the prior high flyers, the growth trio of sectors, tech communication services and consumer discretionary doing well. And then you've got the defensives now taking it on the chin. But I think it's also part and parcel of just increased rotation that's happening in the short term. It's just the mechanics of the market right now. And you can get these days where you see performance shift from what had been the winners. That certainly was the case month to date relative to the first 7 months of the year. And I think these types of things will continue, whether it's driven by probabilities around Fed policy or just more short-term technical conditions.
And Collin, what about you? I mean, to Ann's point, certainly it seemed that the takeaway was that it was mildly dovish. At least that's what the markets took it as we sort of look towards opening the door for a September cut. But as you pointed out, the incoming data still matters. So what are you watching?
Yeah, I think it really is going to come down to that incoming data, and I'm in agreement with Lizanne that maybe it was mildly dovish. The door for a cut appears to be open. It wasn't as solid as what we got last year at this speech, where Powell made it pretty clear that they would likely begin cutting rates soon. Here he just mentioned that, policy is restrictive, and it seems likely that maybe they adjust it soon. But I think if we look, beyond the next meeting in September, I think the path really will depend on that incoming data. And while it's true that the labor market does appear to be softening, especially with those negative revisions we got back in July, inflation is still here, inflation is still sticky, and that is one half of the Fed's mandate. So I think inflation data will still continue to be important. It might take somewhat of a backseat to the labor market data, but I think this Friday's PCE report will be very interesting, especially if we get an upside surprise and maybe that year-over-year core reading hits 3% or so. That's not our outlook, but I think that would be enough to spook the markets a little bit. Our outlook hasn't really changed much based on that mild dovishness last Friday. We do think the Fed will cut rates in September, but we're less confident in what that means in the meetings and months and quarters to come.
Ann, what are you and your team expecting from that PCE reading? I mean, is it likely to show some surprise upside like we saw from the PPI, or what are you watching?
You don't tend to get outlier reports when you get the PCE, in part because once you have the consumer price index and the producer price index at hand, with some knowledge and maybe some clever math, you can map the components of the CPI and the PPI to the PCE, and that's why the range of expectations doesn't tend to be outside the band of consensus expectations. But I think the way to think about whether it's that report or any kind of pricing information we're going to get is, even if pricing were to remain relatively firm, I think if we were to get a follow-on jobs report, the August jobs report, that showed similar kind of weakness, I think that would suggest that the Fed moves. So not that they're not paying attention to the inflation data and only focused on the employment side of their mandate, and notwithstanding the minutes from the July meeting suggesting that most members felt that inflation was the bigger problem, I do think that the labor market probably is a little bit more of the needle mover in terms of not just what the Fed does in September, but what the outlook might be for what the Fed does the remainder of this year.
Yeah, upside risk to inflation, downside risk to labour market. Those certainly were the words of Fed Chair Jerome Powell, and he called it a challenging situation, and they still would proceed carefully. I mean, they've still got to look at the data. Just very quickly, Collin, the yield curve, how are you watching that, given there's been a big focus, particularly on the longer end, given all this pricing in of these cuts?
Yeah, we think long-term yields might stay elevated. We see some downside, but probably less downside than what we see with very short-term investments as we get to those rate cuts that we're expecting. I think it's important to remember that short-term investments are much more sensitive and much more highly correlated to changes to the Fed funds rate in the here and now, where intermediate and long-term yields are more about expectations going forward. So even if that rate cut does come next month, and then again later this year, it doesn't mean we'll necessarily see a step-for-step decline in long-term yields or things like mortgage rates. If we look at the slope of the yield curve, and if we look at the 2-year, 10-year, for example, that's one of the common ones that we and other market participants look at. It's been around 50 basis points for most of this year. And while that's up and an improvement from what we saw for over the past handful of years, it's still relatively low by historical standards. So I think there's room for that slope to continue to move higher. So we think long-term yields will probably fall sharp a little bit more. If you look at the 2-year, for example, it's around 3.7%. If the market expectations are correct, in that the Fed will cut around 3%. I think it's logical to assume the 2-year Treasury should fall to that level, so maybe around 70 basis points or so of more downside. But we don't think long-term yields will fall as much. Inflation's sticky. There's still plenty of fiscal and budget concerns out there and just trade uncertainty that could weigh on long-term risk premiums. So we just see less room for them to fall.
Really appreciate the analysis and insights today. Collin Martin, Schwab Center for Financial Research, and Ann Sonders at Charles Schwab Co. Thank you so much for your time today. Really appreciate it.